Welcome to the Be Smart podcast. Jared, we are 1 week away from night moves. I'm hoping that when it drops, I can get it same day delivery, or at least 1 to 2 days.
Probably 1 or 2 days you can get it. I assume you're getting a physical copy.
Yeah, definitely.
Yeah, I'm going to be ordering like 150 books for book signings and stuff the day of the release. So, it's funny. I'm really hoping for a good release. I'm hoping for a lot of buzz. The buzz seems to be pretty quiet right now. I'd like for it to do as well as Those Bastards. Those Bastards sold 5,000 copies. So we'll see.
How have Kindle pre-orders been so far?
I've sold about 150 pre-orders on Kindle, which I don't know if that's good or bad. A lot of people don't pre-order anyway, and my audience is mostly physical book buyers. So
Right. Okay, let's start with Donald Trump here because, here we go again. Former President Donald Trump is safe after a Secret Service detail opened fire at a man who was wielding an assault rifle at his West Palm Beach, Florida golf course on Sunday, in what the FBI is calling another apparent assassination attempt. You said back when the first one went down that chaos kind of clusters and you kind of foresaw this coming, but this is one of those things where I wish you weren't right.
The smartest thing I've seen about this did not come from me. It came from Luke Groman, if you know who he is. He tweeted something after the assassination attempt. He's like, countries with political violence usually have much higher bond yields. And which is true. Even a country like Argentina, which had one of the most contentious elections in history between Milei and Gonzalez, there was no political violence. There were protests for sure. There's protests in every election, but there were no assassination attempts. There was no violence. And this is really like Banana Republic type stuff. And if you think about the economic conditions that are present in Banana Republics, usually you have high inflation, high interest rates, things of that nature. So before I walked in here, the 30-year bond was at 3.93. And I'm like, you got to be kidding me. Like it doesn't make any sense. It doesn't make any sense. So you can't trade off of an assassination attempt in the bond market, but yield should be much higher after this.
I want to get to bonds in a little bit, but first, a couple of weeks back, you wrote in your weekly letter that you said, I am fond of saying that a bet on commodities is actually a bet against human progress because human beings are smart and find ways to discover more oil and increase crop yields. But how can you look at this election and not believe that betting against human progress is a good idea? I am very bearish on the human race at the moment, which that really caught my eye. And, I was like, yeah, me too, kind of. How much of this bearishness on the human race is driven by the political landscape?
A lot. One thing you have to be careful of is I think people trade too much off of politics. I think I fall victim to that too. People have strong feelings about politics and they try to get trades out of that, and it doesn't always work. I will say that the Bloomberg Commodity Index is up 4 or 5% off the lows. So commodities have gone up for the last 4 days. So I think they've bottomed. And yeah, so betting on commodities is a bet against human progress. And typically the right way to trade commodities is to be short them, right? Because we're always developing new mines, we're always farming new crops, we're always increasing the supply of commodities. And it's usually only when politics get in the way, when government gets in the way, that we muck things up. That's when commodity prices go higher. And I think we're discounting that. I think we're discounting that over the next 4 to 8 or 12 years. I think that's a likely possibility.
All right, let's get to the market headlines this week. First up from the Wall Street Journal, Wall Street turns skittish on eve of rate cuts. The Fed is poised to cut interest rates for the first time since 2020. The size of the first cut and where rates will be 3 months from now is anyone's guess. Traders are assigning a near dead even chance that the central bank will unveil a quarter percentage point or half point cut at the conclusion of its meeting. Where do you stand since last week? Are you still in that 25 basis points camp, or are you now maybe leaning towards 50 basis points cut?
I'm leaning towards 50 now. The market is now your information is probably a couple hours old. We're pricing in more than a 50% chance of a 50. I was sitting at my desk on Friday and I have SOFR up and 2-year notes, and I'm watching, and I kind of turn away and I turn back, and everything is like 6 or 7 ticks higher, meaning lower rates. And I'm like, what the hell just happened? And then I'm like going through Twitter, and apparently there was a rumor that there was a leak out of the Fed that they were going to cut 50. And I'm like, well, that explains it. And I definitely don't want to fade that. Like, if there's a leak out of the Fed that they're going to go 50 basis points, like, that makes me nervous. Once again, short-term yields are down this morning. I don't know the exact number, but I think we're probably pricing in 60 or 70% chance of a 50 right now. Bill Dudley was on Bloomberg Opinion saying we should cut 50. That seems to be the consensus now. My guess is they're going to do 50, but it's going to be somewhat hawkish. They're not going to commit to a rate cut in the next meeting. They might skip a meeting. Kind of depends how they write the directive. In terms of stocks, I mean, I think conventional wisdom is that if you cut 50 basis points, the market's going to go up. May not necessarily happen. What I think is going to happen is that they're going to cut 50 basis points. And I've said this a bunch of times before, but they're going to steepen the yield curve. The front end yields are going to go down, back end yields are going to go up. You're going to have a big twist in the yield curve, and that's going to be the top of the bond market. So that's what I think is going to happen.
And what do you think a 50 cut would mean for commodities and then also for inflation?
Very bullish for both. I think we're kind of discounting that right now, with the rally in commodities the last few days. So, yeah, I mean, look, like in commodities, we got to a point where there was a bunch of commodities, individual commodities, where if you look at the commitment of traders, we had record short positions in a bunch of commodities, including oil. Most people noticed oil, but there was a bunch of other ones too. And there's a huge short base out there that has to cover. I don't think it's really started yet. I think we could be doing the podcast a month or 2 months from now, and commodities could be 10 to 15% higher. I think that's super possible.
Next headline, the S&P 500 is surviving big tech slide as other 493 catch up. So the stock market has recovered most of the losses suffered in its summer sell-off. While the S&P has bounced back before, this time is unique because it isn't being led by big tech. Instead, it's everyone else's turn. Traders are rotating into sectors like real estate, utilities, consumer staples amid fears of a sputtering economic growth, and with the Fed Reserve preparing to cut interest rates as soon as Wednesday. Do you see this trend continuing beyond the short term, this sort of rotation into stocks outside of the Mag 7?
Yeah, that's definitely happening. And I think it's kind of healthy. I think it's technically healthy. We had a correction. The correction started with the end carry trade unwind on August 5th. And stocks have been bouncing around for the last month and a half. And last week, when we had the CPI report, the market was down about 2% intraday, and it finished up about 2%. We had like this 4% reversal. If you know anything about candles, that's called a bullish engulfing candle. It's a very bullish technical pattern. We've had them in the past. Usually, when you get a bullish engulfing candle, the market rallies for weeks afterwards. I am no longer bearish. I have a bunch of puts. I wrote in my newsletter that I'm going to be getting out of some of the puts. So I'm actually kind of bullish in the short term. So
this last headline, I don't know if you'll have any commentary on it. I just thought it was kind of cool. SpaceX crew returns to Earth after a 5-day trip, and it was the world's first commercial spacewalk. Did you see this?
It's absolutely amazing. It's absolutely amazing. And like everybody's focused on Trump and Harris and the election and stupid politics and stuff like that. And meanwhile, we have a private company that does a spacewalk. Like, it is nuts.
It's not even like on front page news. Like it's not
Not
even
on
really in
TV.
the
It's just like
headlines.
totally routine. Yeah. And Elon Musk, I saw his tweet about it. Like he's like, I just did a spacewalk in space. He's like, did I get a call from the president? No. Like nobody cares. We are not that far away from being able to go to Mars.
That was my next question. Is Mars next?
Maybe 3 or 4 or 5 years, something like that.
Holy
Like
shit.
it's incredible.
Yeah, definitely. All right, so I want to move to the main topic. I want to dig into bonds a little further. From Yahoo Finance, they posed the question: is now the time to move some money into long-term bonds with a potential Fed interest rate cut on the horizon? Investors are wondering how this change might affect their finances. A key question emerges: which option will offer better returns, high-yield savings accounts or long-term bonds? What are your thoughts?
First of all, I think it's awesome that Yahoo Finance is telling people to move into long-term bonds. Like that just like validates my thesis that you should just short the crap out of long-term bonds.
Yeah.
If you're a retail investor and you want to get yield, my suggestion would be to go to the bank and take out a 5-year CD or even a 2 or 3 year CD before the Fed meeting, and lock that money up at a 4.5 or 5% interest rate. Like that's what I would do. The other thing is that I don't think there should be anybody panicking about the return they're going to get in their savings, because I don't think the Fed's going to cut that much. Maybe 100 basis points, maybe 150, but you're talking about, you were getting 5.3% in a money market fund and now you're going to get 3.8. It's really not that big of a difference. I think a lot of people kind of have this idea that interest rates are going to go back to zero. We're going to go back to where we were in the 2010s and nobody could get anything on their savings, and they're buying junk bonds at a 4% yield and taking on all this risk. I don't think that's going to happen. It's not going to happen. And I can have money in a money market fund at 3.8%. Like it's totally fine.
You touched on bonds and Dirt Nap today, and you wrote, "He who controls the bonds controls the universe," which is a great quote. Can you explain the importance of allocating some of your portfolio to bonds?
In the awesome portfolio, we have 20% bonds, right? And, my own portfolio is kind of an approximation of the awesome portfolio, except I don't think I have any bonds right now. I really don't. Um, so treasury bonds are overpriced. Corporate bonds are super overpriced. I don't really want to buy investment grade corporates at 150 or 200 basis point spread. Muni bonds are overpriced. Like the whole asset class is super overpriced. Now, if you have the awesome portfolio and you're like, well, why am I in bonds? Just relax, leave it there. It's going to make sense a couple years from now, right? So, like, I don't recommend actively trading the awesome portfolio, even though that's what I do. Like, just do as I say, not as I do, right?
And I saw that the awesome portfolio is doing really well this year, right?
I actually don't know the numbers. I meant to. I mean, I'm going to hook up with Adam at the end of the year and get the numbers. But I mean, I got to figure we're up at least 10, 12% this year so far. That's just a guess.
All right, the week ahead, all eyes are definitely on the Fed, but we've got some more data this week, including the August retail sales report, home builder confidence, and housing starts. Are you looking at any of these data points or anything else besides the Fed this week?
Retail sales is going to be pretty important. I don't think it's really going to affect the course of the Fed meeting. I think the Fed has already decided they're going to go 50. It would take a really blowout retail sales number for them to change course. That's the only one I'm looking at.
You want to wrap this thing up? Anything else you got?
Just night moves in a week. If you're a Kindle person, pre-order it on the Kindle. The link is up on Amazon. Go to Jared Dillian Night Moves, pre-order it on the Kindle. Otherwise, you can buy it on Monday, September 23rd.
By the time people hear this episode, that's only like 4 days away. So
Yep.
get ready. All right. Thank you, Jared. We'll talk again next week.
Thanks.